When Bitcoin first burst onto the scene, it carried this promise much larger than just investment returns. It wasn't really meant to be an investment at all. It was supposed to replenish money itself.
Yeah, the vision was pretty radical. A decentralized, peer-to-peer digital cash system.
A kind of digital rebellion, right, built on the idea that transactions should happen without banks, without governments.
Exactly, without those corporate gatekeepers. And, the folklore always comes back to those two pizzas, doesn't it?
It really does. That developer back in 2010 spending 10,000 BTC on 2 pizzas.
A transaction now worth, what, hundreds of millions? It depends on the hour, really.
It's almost unbelievable, and that story just perfectly captures the fundamental irony we're looking at today.
Because fast forward to, November 3rd, 2025, and the idea of spending even a tiny fraction of a Bitcoin on, well, anything. It feels completely absurd.
Absolutely. Our sources are showing Bitcoin trading somewhere in the, $107,309 to $108,000 range right now.
And the market cap.
Yeah.
It's staggering.
Floating between $2.15 and $2.19 trillion USD. Trillion.
So what started as the world's first decentralized currency has quietly transformed into something, well, entirely different.
A premium institutional speculative asset. It's not digital cash anymore, it's digital gold.
And we really need to dig into how that happened. I mean, governments are now adding it to reserves.
Right, and ETFs are trading billions in daily volume. Institutional custodians treat it just like traditional commodities.
So what happens when a currency basically stops being used as a currency?
Yeah, can Bitcoin ever go back to being money? Or has its success permanently sealed its fate as this speculative store of value? More like an equity or a commodity.
Welcome to Facts Not Forecast, your daily edge in the stock market. Facts, insights, and opportunities you won't hear anywhere else. Okay, let's start with that original DNA. Bitcoin is rightly called the original gangster, right? The most famous crypto, definitely the most widely adopted.
Yeah.
And the white paper itself was crystal clear. Peer-to-peer digital cash. The whole system was designed specifically to cut out traditional banks, cut out the intermediaries.
And those early advocates, they weren't really interested in making a quick buck, were they?
Not primarily, no. They were thinking money for the internet. They were focused on things like transaction velocity, low fees, hoping it would, facilitate the next stage for the global financial system. Truly decentralized, globally accessible.
But here's the twist. The very features that made it so technologically revolutionary might be the ones that actually killed its purpose as everyday money.
You have to talk about the scarcity, don't you?
Exactly. That key technical constraint. It lends itself perfectly to being seen as an asset.
That hard limit of 21 million coins. That's it. Forever.
And with the circulating supply already near 20 million, what's left is 19.94 million, according to the sources.
Right. Around 19.94 million circulating now. That fixed cap, it just inherently discourages spending it.
The market practically forces you into what people now call HODL culture.
That belief you just have to hold on to the asset because mathematically it can only get rarer relative to demand, theoretically.
And then you combine that scarcity with, well, wild volatility.
Oh, definitely wild.
And genuinely strong long-term performance, despite the dips. Holding just becomes the only logical move.
Who's going to spend it? I mean, looking at your wallet, who wants to spend an asset that shows a one-year performance of over 55%, even with recent drops?
It makes no sense from an investment perspective.
Precisely. And despite that recent short-term turbulence, our sources show it dropped, 14.32% over the last month?
Yeah, a swing gold would just never see.
Exactly. That kind of volatility coupled with that massive potential upside, it just destroys the transactional utility.
Right. A real currency needs some relative stability, so you know what your cup of coffee is going to cost tomorrow, roughly.
Bitcoin doesn't offer that. Not even close.
So the focus immediately shifts, doesn't it? Away from consumer adoption, people using it day to day, and straight toward macroeconomic factors. And this is where it gets really interesting.
Yeah, the valuation now seems driven entirely by predictions about central bank policy, just like major equities or commodities.
We see analysts predicting prices hitting $140,000 in November.
And that optimism, that trajectory, it's tied directly to anticipating Federal Reserve easing, the end of quantitative tightening.
Okay, hang on. For listeners maybe not steeped in macroeconomics, what exactly is quantitative tightening? And how does the Fed pulling money out of the system directly affect Bitcoin, which is supposed to be outside that system?
That's a really crucial point. So quantitative tightening, or QT, is basically the Fed shrinking its balance sheet.
Yeah.
It sells off assets, pulls liquidity cash out of the financial system.
Okay, less money float around.
Right. And when there's less cash sloshing around, risk assets, and let's be clear, Bitcoin is definitely seen as a risk asset, they tend to struggle.
So the expectation of easing means the opposite.
Yeah.
The Fed stops tightening, maybe even starts cutting rates, pumping liquidity back in.
Exactly. That expectation of cheaper money potentially pouring back into the system, that's what drives the price of this non-yielding asset up.
Because investors are looking for high growth, maybe high risk places to put that new liquidity.
Precisely.
Yeah.
It confirms its role as a macro-sensitive asset. It reacts to central bank policy now, not just, peer-to-peer payments volume.
It's acting like a global hedge, a speculative instrument, almost completely divorced from its original purpose.
Totally.
And the ultimate signal, I think, that this shift is permanent has to be institutional validation, specifically the rise of the ETF, the exchange-traded fund.
Oh, absolutely. That was the moment Wall Street kind of stopped calling it rat poison squared and started packaging and selling it, like digital corn, as you said.
Yeah.
The ETFs offer a much simpler, regulated way for traditional investors, we're talking pension funds, wealth managers, to get exposure, to access what the sources are calling the OG crypto.
Right. And they allow this exposure without anyone needing to, set up a digital wallet, manage private keys, deal with the actual blockchain mechanics.
It abstracts all that away.
And the scale here is just monumental. We are not talking small startup funds.
No way.
Look at the data from just the big U.S.-listed spot ETFs. it.So, that's the iShares Bitcoin Trust ETF, has assets under management of $85.72 billion. Billion?
It's huge. And then you've got FBTC from Fidelity, over $21 billion AUM.
And GBTC from Grayscale, still massive at $18.26 billion AUM.
Just those three funds?
Yeah.
That's over $125 billion in assets.
Wow.
I mean, to put that into perspective, that amount of capital dwarfs the entire economies of many smaller nations.
Yeah.
And the really important distinction for our deep dive today is how these funds classify Bitcoin.
What do they call it?
Their stated asset class focus, pretty consistently, is listed as currency long Bitcoin, short USD.
Huh. So they're packaging it as currency exposure for these big institutional portfolios?
Correct. But the very act of packaging it like a security, trading it on stock exchanges, that feels like the final nail in the coffin for that original peer-to-peer dream.
That packaging creates this profound paradox, doesn't it? The institutional success, the very thing that helped drive the price from, say, $10 way up past $100, it completely undermines the original philosophy.
It really does. The core ethos was decentralization, separation from state control, from corporate control.
And this brings up that critical counterargument we found in the source material.
Which was pretty provocative.
The claim that Bitcoin's decentralization is actually, well, a lie.
Yeah, that it's become one of the most centralized, surveilled, and manipulated financial systems in existence. Strong words.
But hang on, how can that be true if it fundamentally runs on a distributed ledger that nobody controls? Isn't the whole point that the transactions are spread out across thousands of nodes globally? How can it be centralized?
That's the common understanding. But you need to differentiate. The distributed ledger, the blockchain itself, handles the record keeping. It ensures the transaction history is consistent and tamper-proof, distributed across those nodes.
Okay, so the ledger is decentralized.
Yes, arguably.
Yeah.
But price discovery, figuring out what a Bitcoin is actually worth at any given moment, that's where the centralization really hits hard.
How so?
Because the vast majority of trading volume, the activity that actually sets the price, doesn't happen through millions of people buying coffee.
Yeah.
It happens on a handful of massive centralized exchanges.
You mean like Binance, OKX, Coinbase, those big platforms?
Exactly. These exchanges control the primary access point for most users. They control the liquidity pools, and crucially, they control the derivatives markets.
So it's like the distributed ledger is the road network spread out everywhere, but Binance and Coinbase are like the only two giant gas stations everyone has to use, so they end up controlling the flow and the price of gas.
That's a perfect analogy.
Yeah.
And it gets even more centralized when you look at instruments like Perpetual Swaps.
Ah, okay. Explain those. For those of us not glued to high-frequency trading desks, what exactly is a perpetual swap? And why does that instrument, rather than someone actually buying Bitcoin to, say, send across borders, now define its value?
Right. So a perpetual swap is basically a futures contract, a bet on the future price, but one that never expires. You can hold the position indefinitely, hence perpetual.
Okay.
It allows massive traders to speculate on Bitcoin's future price using huge leverage, sometimes 50x, even 100x often, without ever needing to hold the actual underlying Bitcoin.
Wow. Okay, so it's pure speculation on the price movement.
Pure speculation, highly leveraged, and because these contracts are traded in enormous volumes on those same massive centralized platforms, they create overwhelming price pressure and volatility. The spot market, where you buy actual Bitcoin, often just has to follow the lead set by these derivative markets.
So that process reinforces Bitcoin's function purely as a heavily traded financial instrument.
Absolutely. It's become a vehicle for leverage, not primarily a medium for transactions.
And that shift just confirms the ultimate irony here, doesn't it? The market structure that was necessary for its staggering, $2 trillion plus success
Has simultaneously made it basically unusable as everyday money.
The synthesis seems pretty clear then. You've got the high price, the ETF legitimation, making it easy for big money to get in, the inherent scarcity.
And the institutional speculation driving price targets like 140K.
It all confirms its function now is really as a digital store of value, something to be held, maybe hedged against inflation, allocated against other asset classes.
Exactly.
So for the typical investor listening, we should definitively look at Bitcoin today as a global speculative allocation, basically a digital commodity.
I think that's the most accurate description of its current function, yes. Its price action is now completely intertwined with other global markets.
You see it trading against every major fiat currency pair, BTC JPY, BTC KRW, BTC EU, BTC BRL. They're all active liquid markets.
That ubiquity just supports its classification as a major tradable commodity. It's simply become too valuable, too volatile, and frankly too legitimized by these institutional products to realistically go back to being used for daily transactions on a mass scale.
The ultimate measure of a currency is supposed to be transaction velocity, how often it actually changes hands in the real economy. But with Bitcoin, as the price goes way up, the transaction velocity tends to drop. People hold it tighter.
It's the HODL effect in action.
Which is a complete paradox for something claiming to be money, right? Money needs to move.
Precisely. So while that initial vision was digital cash, it feels like the market effectively killed the currency by making the asset too good at being an asset.
Bitcoin started as a rebellion, this powerful idea that money could exist outside government control.
A fascinating premise.
But somewhere between that ideology and, well, Wall Street embracing it, it just became another ticker symbol. So here's the real question, I think, for investors today. If basically no one ever spends Bitcoin again, does it still even count as money?
That's the $1 million, or maybe $100,000 question.
Or has it simply become the most successful failed currency in history?
Something to think about.
Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.